many people who just refused to look at Bitcoin said, wait a minute, what? There's nothing like price action in a bad market, good price action in a bad market, to elicit the interest of investors who were poo-pooers before. And so that's what happened, because for the first time, Bitcoin became a risk-off asset in their eyes. They had only thought of it as a risk-on asset, very volatile, does well in bull markets. But this was a very loud signal.
Hey guys, welcome back to Everyday Finance. In this video, Cathie Wood discuss about Bitcoin and other crypto. According to Cathie Wood, a significant wake-up call for the financial world in terms of last year. Bitcoin was affected by the regional bank crisis as indicated by the K, which represents the regional bank index in the United States. States were in a state of chaos when Silicon Valley Bank and other financial institutions collapsed, causing Bitcoin to surge. 40% and many individuals who simply chose not to consider Bitcoin were taken aback by its potential. Effective price movement in a challenging market can attract the attention of hesitant investors. Before, that's what happened because, for the first time, Bitcoin became a risky asset in their eyes, previously viewed as a high-risk asset with significant volatility, performing best in bull markets. However, this recent development is a clear indicator of change. It seems like the SEC has given the go-ahead for ETFs, and ETF ARKB is one of them. Encourage an increasing number of individuals to consider your message. This is a new asset class, so the community of advisors may not be familiar with it. It's important to have a perspective and explain to your clients why you believe in it, excluding it, because the pattern with new asset classes is that when an allocation is made into one of these new options by incorporating different asset classes into your current portfolio, the return per unit of risk increases due to diversification. Given its low correlation to other assets, more advisors and investors are now taking it seriously, and lots of things Cathie would discuss. So please watch the video to end and share this video and subscribe our channel Everyday Finance. Thanks.
Yeah, a big wake-up call for the financial world in terms of Bitcoin was during the regional bank crisis last year, as the KRE, which is the regional bank index here in the United States, was absolutely imploding. When Silicon Valley Bank and others went under, Bitcoin increased 40%. And, many people who just refused to look at Bitcoin said, wait a minute, what? There's nothing like price action in a bad market, good price action in a bad market, to elicit the interest of investors who were poo-pooers before. And so that's what happened, because for the first time, Bitcoin became a risk-off asset in their eyes. They had only thought of it as a risk-on asset, very volatile, does well in bull markets. But this was a very loud signal. And I think the SEC signal, the green light with the ETFs, our spot ETF, ARKB is one of them, did get more and more people thinking about what you said, Ed. This is a new asset class. So advisor community, you may not like it inherently, but you must take a point of view and tell your clients why you're not including it, because the history of new asset classes is that when you put an allocation into one of these new asset classes, into your existing portfolio, the return per unit of risk goes up because of the diversification and the low correlation to other assets. And so a lot more advisors and investors are taking it seriously now.
According to Cathie Wood, we always assume that the spreads, especially in the retail sector's high expectations for Coinbase, were expected to decrease significantly due to Bitcoin. We were surprised by how low the fees were on the Bitcoin ETFs. But our initial assumption was correct. Anything that encourages more investors to participate in the ecosystem is crucial. ETFs serve as a stepping stone for individuals, for those looking to establish a foothold in the world of Bitcoin. As they delve deeper into the subject, many will start using it as a gateway. transitioning into setting up their own wallets would greatly benefit Coinbase by allowing them to join in. We are focusing more on other decentralized financial services, which we believe will serve as a gateway for Coinbase in the future. There may be some revenue impacts in certain areas, but we believe the approval of the ETFs will be positive. This will provide a significant long-term boost to the pricing of all these assets, which bodes well for Coinbase. Let's back to the Cathie Wood interview.
Yeah, we had already always assumed that the spreads, especially in the retail sector, which were very high for Coinbase, were going to come down dramatically because of the Bitcoin ETFs. We didn't know how low the fees would be on the Bitcoin ETFs, but nonetheless, that assumption is correct. Anything that gets more investors involved in the ecosystem is important. The ETFs are a stepping stone for people who want to just get a toehold in. But as they learn more and more about Bitcoin, many will use this as a bridge into establishing their own wallets, which would be very helpful to Coinbase, so that they can participate more in other decentralized financial services. So we think this is going to be a feeder for Coinbase. Sure, there could be some revenue hits in some ways, but the approval of the ETFs, we think, will be a powerful boost longer term to pricing of all of these assets, which will be very good for Coinbase. Yeah, well, one thing, we've set up our research department so that our analyst responsibilities are organized by technologies. So they're tech specialists, sector generalists. So our portfolios, all of them, are much better diversified plays on disruptive innovation than you would get in sector tech funds. And one of the reasons is something you didn't mention, which is the multi-omics sequencing, which is going to transform healthcare as sequencing and artificial intelligence converge with CRISPR gene editing to actually cure disease. So our ARKK is our flagship strategy, and it will be soon, we hope, with regulatory approval in Europe, be heading for Europe as well, with our partner Ark Europe. So excited about that. And then we have more specialized portfolios. One is the next generation internet, which is focused on AI and blockchain technology heavily. One is the multi-omics sequencing revolution, or I think we still call it the genomic revolution. We have to change the title there, but that's ARKG. The autonomous technology and robotics portfolio, so that's autonomous taxi platforms, robotics, and 3D printing. That's ARKQ. FinTech, which is importantly crypto and blockchain technology, is an important subset. It may absolutely take it over long term, but right now it's a subset of our FinTech portfolio, ARKF. I think I didn't give you the ticker for ARKW, which is the next generation internet. So, and then we have ARKX, which is even more out there in outer space. That's our space portfolio. Well, I think in terms of the public equity markets, we are the closest you'll find to a venture fund in the public markets. And that's because our portfolios don't look anything like the broad-based indices. In fact, the overlap is 5%, maybe 8% at tops. So you've got 92% diversified exposure to truly disruptive innovation, whereas the big broad-based benchmarks really are made up of companies that have been very successful historically, but may be disrupted. So we are a very good hedge against the possibility of that. So many use our strategies as a hedge against the disruption elsewhere in their portfolios, and others just allocate to us because they know from their own lives that we're talking about the way the world is going to work, not the way the world has worked. And just to close that off, when I was trying to explain to someone why I needed to start ARK 10 years ago. And this was someone not in our business. He ended up saying to me, so you mean that the future of investing is investing in the future? And I said, precisely. So it's a bit cheeky perhaps, but it is true.
Cathie would consider the public equity markets when making decisions, closest you'll find to a venture fund in the public markets, and that's because of our portfolios bear little resemblance to the broad-based IND indices. In fact, there is minimal overlap, 5%, perhaps 8% at most, giving you 92% diversified exposure to truly disruptive innovation. Unlike the major widely used benchmarks, consist of companies that have a strong historical track record, but could be disrupted. So we are a reliable safeguard against such possibilities. Many rely on our strategies for protection. Some investors seek protection from disruptions in their portfolios, while others entrust their investments to us based on our reputation. We're discussing the future and how the world will operate, not dwelling on the past. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.